Imagine being able to offset the income from your practice with losses from your rental properties. Well, for some physicians, that's not just possible, it's completely IRS-approved. However, doing so requires having real estate professional status. Today, we're going to explore how that works. We'll cover the 3 critical tests that must be passed in order to acquire real estate professional status. Ready to learn to make your real estate work for you? Let's get started. We'll start with the tale of 2 doctors. Dr. Anna and Dr. Basil are alike in many ways. They are both unmarried and both earn a W-2 of $300,000 a year as pediatricians. They also both own several rental properties that have run-up losses of $50,000 due to renovations, etc. Alas, the resemblance ends because while Dr. Anna pays $54,362 in income taxes, Dr. Basil's tax bill is a great deal more, which is $71,955. Dr. Basil pays $17,593 more than Dr. Anna in income taxes. To get a better picture of why Dr. Anna was able to successfully navigate the IRS code, let's define a few terms that may seem puzzling. First, let's discuss what passive and non-passive activities are. According to the IRS, passive activities include trade or business activities in which you don't materially participate. You materially participate in an activity if you're involved in the operations of the activity on a regular, continuous, and substantial basis. That means is that if you're involved in the activity on a regular, continuous, and substantial basis, that activity is considered a non-passive or active activity. This distinction is important because it affects how losses are treated. The general rule is that losses incurred from conducting a passive activity can only be applied to reduce the taxable income from another passive activity. Losses from a passive activity cannot be used to offset the income from a non-passive activity. Non-passive income includes income from wages, salaries, and self-employment. This means that Dr. Anna should not have been able to apply the $50,000 loss from her real estate venture to reduce her taxable earnings from her practice. But she did, legitimately. Dr. Anna was able to recharacterize the losses from her passive real estate activities into non-passive losses, which she could use to reduce the non-passive income from her practice. How was she able to do that? To find the answer to that question, we must first discuss how the concept of material participation applies to real estate activities and the role it plays in having passive income treated as non-passive income. As we've already noted, if someone materially participates in a business, income from that business is considered non-passive or active income. However, that general rule doesn't apply to real estate activities. In general, income from real estate activities such as rental income is considered passive income, even if you materially participate in the activity. Nevertheless, to be able to treat rental activities as non-passive, a taxpayer must first have materially participated in them. Material participation in rental activities is a necessary but non-significant condition. In fact, passing the material participation test is the first step to gaining real estate professional status. You will be materially participating in a business if you satisfy any one of these conditions. Condition number 1 is the 500-hour test. If you were involved in the activity for more than 500 hours during the year. Second is substantially all participations test. You perform substantially all the work required for the activity. Number 3, 100-hour and no more participation test. This means if you spend at least 100 hours in the activity during the year and no other person spends more time on that activity than you. Number 4, the significant participation activity test. If you participate in multiple activities that each require significant involvement and your total time across all the activities exceed 500 hours in the year, you qualify for this one. Number 5, the facts and circumstances test. Based on the nature of your involvement and the role in your activity, if the time you commit is regular, continuous, and substantial throughout the year, you qualify under this test. But note that you didn't materially participate in the activity under this test if you participated in the activity for 100 hours or less during the year. Number 6, the prior year test. If, based on any of the above rules, you materially participated in the activity for any of the 5 of the last 10 years, including non-consecutive years, you qualify. Number 7, personal service activity test. If the activity is a personal service business and you materially participated in any of the last 3 years, you qualify for number 7. You will have noticed that test number 7 referred to significant participation. So let's take a look at what that is. Significant participation is relevant to passive activities in which a taxpayer is not fully materially participating, but is still engaged to a substantial degree. So you significantly participate in business activity if you participate more than 100 hours, but less than 500 hours during the tax year. Under the significant participation rule, several passive activities may be grouped as one, so that part of the passive income from those activities is treated as non-passive income. What happens if you are unable to satisfy the material participation rules? Have no fear. You may qualify for some tax relief under the active participation rule. We'll explain the active participation rule in a while, but for now, let's continue setting out the steps to acquire real estate professional status. 500 hours a year? That's roughly 10 hours a week. Fortunately, you may not have to clock all those hours yourself. You can pass on the responsibility to your spouse. If you're married and filing jointly with your spouse, your partner can do the heavy lifting. It's an ideal situation if your partner welcomes a part-time gig. Having cleared that hurdle, let's see what it takes to get that coveted real estate professional status. The rule is that a taxpayer can treat their real estate activities as non-passive if they qualify as a real estate professional under Section 469C7 of the Internal Revenue Code. To qualify for this exception, they must meet both of these following requirements. More than half of their personal services performed during the tax year must be devoted to real estate activity in which they materially participate. Also, the taxpayer must perform more than 750 hours of service in real estate activities during the tax year. Test number 2 shouldn't be a major obstacle as long as you don't work full-time as a physician or any other work activity. Your spouse can even qualify for test number 2 if they don't work full-time. However, test number 3 is more challenging. 15 hours or more a week must be spent on real estate activities to satisfy that test. If you're not able to pass these 3 tests to qualify for real estate professional status, all is not lost. You may be able to pass the active participation test, which is less stringent. You're actively participating in real estate activities if you're making key decisions regarding the property or properties, such as approving tenants or making capital improvements. To qualify for the rule, you must own at least 10% of the rental property and make significant management decisions, such as approving new tenants, deciding on repairs, etc. If you do actively participate in rental real estate activities, you may be able to deduct $25,000 of rental real estate losses against your ordinary income if your modified adjusted gross income is $100,000 or less. This is a neat deduction that unfortunately phases out between $100,000 and $150,000 of your modified AGI. For many docs, you will probably make way too much money. As you will have realized by now, the IRS is more likely to approve real estate professional status if you have written proof of the real estate activities you've performed and the time you've spent on those activities. For instance, you can use an appointment book, calendar, or a narrative summary to track the time spent on real estate activities. You don't have to have the document these activities right away, but it's best to write up your records before essential details fade from memory. Recreating records after a long time has passed can be difficult. Indeed, many tax court cases have turned on this point, with the court not allowing the claim for real estate professional status if the taxpayer couldn't provide sufficient written evidence of their real estate activities. There are also apps available to help electronically keep track of your real estate activities. Given the 750-hour requirement, it's unlikely you'll qualify as a real estate professional if you only own 1 or 2 properties. The exception is that if one requires significant work, such as renovations. However, if you own several properties and manage them yourself, keeping track of your time and efforts is well worth the investment because any losses that occur can help to offset your ordinary income from your W-2 or business. The short-term answer is yes, they can. Short-term rentals such as Airbnbs or VRBO properties are not considered rental activities. This means you don't need to qualify as a real estate professional to deduct losses associated with those activities. However, note that to be a short-term, average period of customer use must be 7 days or less, or 30 days or less if you provide significant personal services to your customers. However, you must demonstrate that you materially participated in the activity during the year. In addition, you must be the one participating the most in that property and spend at least 100 hours a year in each of your properties performing real estate activities. So, physicians without an available spouse to manage their real estate portfolio may choose to invest in short-term rentals to avoid the passive activity loss limitations. Qualifying as a real estate professional only makes sense if your real estate rental investments produce losses. For physicians who own or consider owning rental properties, qualifying for real estate professional status could allow you to use your rental losses to reduce other taxable income, such as income from your practice or W-2s. If your properties are profitable, losses will not offset other income. However, it's essential to first ensure that you meet the necessary qualifications and accurately track the time spent on your real estate activities. If you found this video helpful, don't forget to hit the like button and subscribe to the channel to stay up to date on all of our new videos. Have any questions or thoughts on the complexities of passive activity loss rules and rental activities? Drop them in the comments below.